Over the last year, the central debate for markets is whether the global economy will slide into a recession versus a recovery in 2020. Now, while the economy remains in a delicate position today, the good news is that we see the stage being set for a mild economic recovery in mid-2020. History shows that markets tend to rally after the Fed's initial rate cuts, and this uptrend is typically sustained if investors see increasing signs that a recession will be successfully averted. Over the next few months, we see more upside for markets ahead as investors receive increasing confirmation of a growth recovery alongside improving data and the likely completion of a US-China Phase 1 trade deal. We expect the decade-long bull market to continue in 2020, given that monetary and fiscal policies remain supportive and that clear imbalances in the financial markets or emerging market economies, which tend to accompany recessions, are largely absent today. That said, there is a need to moderate return expectations for 2020. As we head deeper into next year, we see challenges from still relevant late cycle forces, such as pressure on corporate margins and high debt levels, in addition to geopolitical uncertainties from the US presidential elections and US-China tensions. Moreover, valuations of risk assets today are already near fair value, and they are higher than the levels seen during past recoveries in 1995, 1998, 2012, and 2016. We do see, however, that because interest rates today are lower than historical levels, there is some additional scope for valuations to rise further. Against this backdrop, we have a moderate risk-on position in our overall asset allocation strategy, expressed through our overweight positions in Europe equities and emerging market high-yield bonds. Relative to the US and Asia, we find better risk-reward in Europe equity valuations, which are largely discounted for the economic weakness in Europe and the geopolitical issues relating to Brexit and Italy. We also like the attractive carry from emerging market high-yield bonds. Bottom-up company results in this space remain broadly firm, and valuations today are relatively undemanding. This asset class is well placed to continue receiving broad-based support, with much of the world's bond markets at low or even negative yields.